Hi, it's Ben Sutton with Mazuma, here to talk about your monthly reports. Last time we talked about the profit and loss statement, and so in this clip we're going to talk about the balance sheet, or the statement of assets, liabilities, and equity. This report is different than the profit and loss in that it is showing non-income, non-expense items, such as your cash account. It starts with your most liquid asset at the top, which is your checking account, your cash. Could be savings account also. And it indicates that as of the end of June, we had 23,752 in cash. Move down to the next category called fixed assets, and the only account here in this simple example is the furniture and equipment account, showing that over the course of from the beginning of time in this company, we've spent about $7,100 on furniture and equipment. And you might ask, why would furniture equipment show up on the balance sheet instead of on the profit and loss statement? You know how the IRS and other accounting standards often don't allow you to deduct or expense things all at once, right? If something is going to be used over the course of multiple years, then they have you capitalize it or place it in this asset account and then depreciate it over the course of future years. And so that's why we have these amounts here in the fixed assets, furniture and equipment, for example, and they're kind of stored here, lumped together here, instead of running through the profit and loss. And so you might have vehicles or buildings, accounts receivable, other things like that that aren't yet income or expenses, but will be in the future. And so in this simple example, like I said, all we've got is furniture and equipment. Total assets. We move down to our current liability, and the first one, most liquid liability, you could say, is our credit card. Balance of $29.81 as of June 30th. Another liability or debt is a loan that the company's received from its shareholder. Now that shareholder may be you, right? If you're the only owner, only shareholder, if you still have the ability to loan the company money and expect a payback, and even a payback with interest if you've structured it that way. Other liabilities may be mortgages or equipment financing, things like that that are long-term debts that are going to take time to pay off. And so this can be a pretty useful section of your balance sheet, looking to see what are my debts compared to my assets. If I needed to liquidate my debt, could I do it? Could I pay it all off right now if I wanted? Am I solvent? And that's really the question that you could answer with that little analysis right there, comparing your current liability, your liabilities, with your assets up above. The last section of the statement is the equity section, and this section's a little bit more complicated in some ways, but we've got a really nice, easy example here. So this equity section would track money coming in from owners or money going out to owners that is not wages, that's not like payroll, but owner distributions, or some people call it dividends, but it's unless you got a C corporation, it's better identified as a distribution, because there's no extra tax on a distribution like there is on dividends. So we've got here from the beginning of time, from the beginning of this company's existence, the owner has withdrawn $118,000. Retained earnings and net profit, they're kind of the same thing, except retained earnings is the account that shows the total cumulative net profits from prior years, from prior periods, whereas the net profit line shows the current year profits. So we see maybe this net profit line, 72,815, will actually tie out and match the year-to-date profit right up here on our profit and loss statement. And I want to note something on as we go down to the balance sheet and show you a little question, a little analysis you can do as you think through your numbers. Remember this $3,000 current month net profit. Some people ask, if I made $3,000 this month, why isn't it sitting in my cash account? Where did it go? And you can see where it went by analyzing these accounts. So we can see right here that cash did go up by actually about $11.50. So we'll take that $11.50 right there and just add it up. Now we didn't spend anything on furniture and equipment, and I'm going to come back to the liability section. But the other quick question: if your cash account didn't go up, maybe the owners pulled the money out. So if we look here, we've got a quick. Looks like about $37.50. The distributions went up by $37.50, meaning the owners took out an additional $37.50. So we'll add that together there. That's $4,900 of cash that flowed either into our checking account or out of the company. And you might ask, well, how did we get $4,900 out of the company if we only made a $3,000 profit, right, as identified here this month? Well, and that's where we come back to this liability account. You can see that during June, the owner put about $1,900 on the credit card, right? If we take $2,981 minus $1,089, that's about $1,900. And we subtract that $1,900, and that gets us back to our $3,000 profit. And by putting that $1,900 on the credit card and increasing their liability, it freed up some cash to be pulled out or to be banked in the checking account. But it also increased their liability that they're going to have to pay off in the future, right? So those are just some of the questions you can ask and answer by using your balance sheet. Hope this was a helpful session for you. We'll move on to the next one. Thank you.